Okay, so we know rates are going up. Okay, that's inevitable. Where they're going to go to, we don't know. But wonder if I can lock you in at a much lower rate than the 30-year fixed rate is today, and that rate is good for 10 years. Don't go away. I'm going to discuss that next. So let's retro all the way back into the early 2000s when housing was going crazy. And there was a product out there, it was called an adjustable rate mortgage. But before you turn the dial, hold on a second. Okay, so back in those days, that was the biggest problem that the market faced. And it was basically the catalyst that crashed the market. You can even go back to or go search in Investopedia or wherever you want all over the web, and it's going to show you adjustable rate mortgages were the culprit. Okay. However, right in this area here, interest only and payment options arms, both adjustable rate mortgages. Okay. So that's where we're going to start with this segment. Now, before everybody says, whoa, 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 here we go again, Dan, you posted subprime junk loans the other day, and now you're back to pushing arms. No. Throughout the years, the whole system has learned a lot when it comes to adjustable rate mortgages. So I have a video here that I'd want to share with you, and it's a sales trainer that we have that's educating my staff as well as staffs all over the country on the program that we're able to offer you guys. So watch the video, and then when we come back, I'm going to debunk a few things that you might have. But I also want to throw this in there just for context. The average mortgage out there in today's world lasts, well, it's set up on a 30-year term. However, it usually pays off within the first 10 years. So keep that in mind while you're watching them.
So the reason why I'm so passionate about this, because I know for a fact that this presents the lowest payment option that does not present the amount of risk that everyone assumes that it does. So we have to make sure that we're out there educating our buyers and our borrowers that this exists, because it's a significant advantage to anyone that takes advantage of it. And I'm going to tell you why. Okay, so let's just kind of go into the education of adjustable rate mortgages. So adjustable rate mortgages instilled a lot of fear in the buyer or the borrower due to what happened in the early 2000s. Now, what adjustable rate mortgages did in that time was create negative amortization and essentially put people in foreclosure. Now, what they had was called, option arms, to where you could essentially determine on if you wanted to make a principal balance payment or not, right? But the thing is, the massive fluctuations in the market and the lack of adjustment caps, while also being penalized through negative amortization that would essentially expedite the process in you losing that house, is what crashed the entire market, right? Option arms and the kind of adjustable rate mortgages that existed then gave a false perception of someone's ability to afford a house, right? It was almost like renting a $500,000 house, assuming that one day you were going to make the decision to make a payment that you just never ended up making, thus putting you in a significant amount of debt. No one wants to put themselves in that position again, right? And to me, with what adjustable rate mortgages are now, due to the added protections within adjustable rate mortgages, it is a much more secure program that allows significant pricing and payment benefits. Okay. Now, the reasons why it's much more secure in doing an adjustable rate mortgage now is because there are protections in place to prevent or minimize the increase in monthly payments and limits you from experiencing that payment shock that everyone was so fearful of. So it is your opportunity to be able to educate buyers that do not understand the value in such an amazing product. Okay. So let me speak to you a little bit more about what an adjustable rate mortgage is. Now we have a 5/6, a 7/6, and a 10/6 SOFR arm. Now, typically in the past, adjustable rate mortgages were tied to the LIBOR, the LIBOR index, which was seen to be one of the more stable indexes, right? But That's not the case anymore. The SOFR index is actually much more stable than the LIBOR or any of the other indexes that could be tied to an adjustable rate mortgage. Now, when it says 7.6, 10.6, 5.6, what that means is the first number is how long the mortgage is fixed for before it goes into its adjustment period. Now, the 6 in this equation is once it comes out of its, or once it goes into its an adjustment period, it can adjust every 6 months. Okay, every 6 months. Now, during those adjustment periods, there are different caps depending on which adjustable rate mortgage that you choose. So, for example, when you're looking at a 5.6 SOFR arm, when you come out into your first adjustment period, it can only go up 2%. So let's say that you start off on a $400,000 house at 3%, then 5 years later, it can only go up to 5%, right? Same thing with the 7 year and the 10 year or the 10.6. Now, what's great about the 10.6, which blew my mind, is what the pricing difference is and the payment difference is compared to everything else, right? So when you're looking at a 10.6 arm, it is going to be fixed for 10 years. So it will not change until the year 2032. All right. Now I want you to picture something. So if you get a 3.25% today, the most it can go up is to 8.25 in 2032. Now another great part about adjust rate mortgages now are those protections that are in place that I was talking to you about that are comprehensive with these adjustment caps. Okay, so the adjustment caps will allow you to re-amortize, or we will re-amortize or recast the loan to the lesser balance than where you started. So let me give you an example. So typically what you're going to do is you're going to sell a 30-year mortgage, okay? A 30-year mortgage. So if you were to sell a 30-year mortgage at a $400,000 loan amount at 3.25%, the payment would be $1,888. Now, when you get to your 10th year in a 30-year fixed mortgage, this is what it's going to look like. Your remaining balance is going to be $314,152. All right. And you would have also paid $140,773 in interest. Now, if you were to do the 10.6 arm in year 10, you would have paid down the balance to $306,917. But the significant part is this: you would have only paid $115,816 in interest. So 115 to 140, 306 to 314. You can see the significant difference. Imagine what a buyer could do with the extra money and interest savings alone within that 10-year period. That is a significant amount of savings. Now, something I want you to think about is this: is if we were to recast the interest rate, let's say it goes up to 8.25%. If you were to recast the 8.25% comprehensive with the 306, your payment isn't going to be much more than where you started at 400,000, right? So it minimizes that increase in monthly payment when it goes into its adjustment period. It softens that blow, but it cannot even come close to how much you were able to save or see as disposable income with that previous 10 years.
So from the video, I hope you learned a lot. Adjustable rate mortgages are more secure than they used to be. They have safe havens in there built in, so things can't get really out of hand. The biggest feature here is what Sean actually mentioned, was the recast feature. So after 10 years, when your rate starts to adjust, now his numbers actually reflected what the payments would do after the 10 years if the rate maxed out. Well, do we see rates getting to that point? I don't. But even if they do, did you notice the payment was almost what it would have been 10 years prior on the fixed rate? So what happens after 10 years, your loan will start to recast on the new rate, but the payment's not going to get out of hand, even as Sean showed you, if rates went all the way and maxed out to the 5% adjustment from your start rate, so the rate was in the 8s. Your payment wouldn't be much more than what it would have been if you took the fixed rate, 10 years prior. So these are just one of the things that we offer our clients. So if you think this might benefit you, if you're trying to refinance or you're trying to build a house and the rates have gone up substantially from where you started, maybe this is a way to put the payments back in line for you. So if you want to find out more about this program, please reach out to us. The best way to do that is go to therateupdate.com, and then there's 3 ways to get started. One, you can give us a call, 844-775-5626. 2, schedule a meeting. You click there, a calendar opens up and gives you the days and times we have available. Or 3, click the apply now button. Once you finish the application online, we'll be sure to reach out to you probably within about 10 minutes to answer any and all questions that you had. So thanks you so much for watching the video. I hope you found value in it. If you did, please give me a thumbs up, subscribe down below, hit the bell every time we post a video. You get an alert. I'll see you next week, guys. Take care. Bye-bye.